Thank you, everyone, and good morning to all of you. I hope you've had a productive conference so far. Hopefully, you're meeting some great connections here, and thank you for sitting in here today. My name's Nema Daghbandan. I'm a partner with Girassi LLP. I manage the firm's loan document and compliance group. We basically advise lenders on a nationwide basis. The two people on stage with me probably don't need a lot of introduction. They run two of the household names in our business. They're probably your fiercest competitors and people who you shop your loans against oftentimes and are probably frustrated by. Stories are incredible, and their arcs are also very incredible to listen to. And so today, hopefully we can give some light onto how to manage and scale a business, particularly the lending business, of this size and scope. It's not accidental to get to the size that they are at. Their stories will evidence that. And they've really got both of them have tremendous grit and capability that I think will kind of come out from today. But before we get into all of that, I do want some interesting facts here is first, they've never been on stage together. So
I know, it's the first time for me.
Another interesting fact is that Beth is Steve's biggest Instagram fan.
Yes, I'm a little bit of a teenage girl, but...
I didn't know Steve had an Instagram because I don't use Instagram. So Steve is much cooler than I am. Is also what I've learned from this. But if
I hooked you up with it though, right? I told you.
You told me about it.
You got to check out this Instagram feed.
Apparently amazing. I don't know if it's dogs. I don't know what it is, but amazing.
It's not cats. It's not dogs.
But has an amazing Instagram feed. I can attest to Steve's LinkedIn feed, and he has a great book club. So if you are into books, he's got good book reviews going on there. So. Give you a little bit of an idea of the two businesses that they have been able to build. Both CoreVest and Anchor have both originated more than $1 billion of loans last year. Together, they originated more than $3 billion of loans, to kind of give you an idea of just the scope of what they've been able to build. That foundation and how they got there, I had an opportunity to speak with really both of them and have an opportunity to really understand kind of what got you here and the arc that you took. And so I think that's really something I want to kind of start off here. And if you trace it back, it's actually really interesting. If you go back to kind of the early 90s is where I think the arc really starts in a significant way for both of you. And so Beth, kind of looking at you first, you're an attorney at Latham & Watkins,
yes,
which is an international law firm, well-renowned. And you're recruited from Latham to go to Goldman Sachs.
Yes.
Right. So tell us a little bit about those first few years at Goldman, and before Asia. That's where I want you to end this story.
End at Asia?
And
okay.
Before Asia.
So ironically, I was recruited. I think this is probably a lot of our careers are going to show this, but I was recruited in one of those kind of boom years to Goldman for what was going to be kind of this fancy group, like an internal consulting group. They were going to hire some lawyers, hire some bankers, maybe some consultants, some IT, and have this, fantastic little group of people who could do projects who were interesting. And this was a bull market year, and so that's why they had that bull market idea. By the end of the year, the Russian debt crisis was starting to happen. It was the first year ever that a Goldman Sachs partner lost money in their account versus made money in the account. And this fantastic bull market group was shut down about 8 months after they started it. And out of the kind of 75 people that they had hired into this management consulting group, 4 of us managed to find internal jobs at Goldman in other places where they were still hiring. And so it was kind of one of these little scramble to something you could do. And it was the first time in my career that it was actually the real estate principal area was looking for somebody to do a bunch of things. And I wound up in the Whitehall funds, which was the real estate principal area at Goldman Sachs, never having touched a piece of real estate in my life. Right? And never really having done any financing. So it is absolutely better to be lucky than good. I like to think I was at least a little bit good, that I managed to get through the interview process, but somehow they took a flyer on me. And they took a flyer on me because they were looking for some skills that they didn't have. They weren't necessarily real estate related skills. But I wound up going in, I wound up becoming the chief administrative officer for the Whitehall funds globally, which entailed all of the fundraising, structuring, running different businesses, setting up businesses around the world really for them when we needed something like a servicer that we didn't have, or we would be buying assets and all of a sudden we'd have a ton of assets and we didn't know what to do with them, or we needed a joint venture partner, or or whatever happened wherever we were, wound up becoming the person who sat on a few boards in Bangkok, in Tokyo, in London, and then wound up actually moving to Asia when the beginning, again, of the next crisis happened. There was the Asian debt crisis, and I moved there to help buy NPLs all over Asia after having done some bad bank purchases and things like that in Europe. So it was very fortuitous that I wound up being in a group that had a lot of capital to deploy, but didn't have people who were doing some of the strategic building activities that I wound up luckily being. I was the person who kind of had the bad job, right, of setting up stuff from scratch versus being able to go out and source and do all the acquisitions. And so then wound up in Asia, setting up a bunch of different entities there for the assets we were buying.
And even during that time too, this is also part of your story, and to a great degree your success is the connections you're making all along the way, right? And so who are some of the people you're working with at Goldman at this time?
The other kids in the group?
The other kids in the group.
The other kids in the group now, okay, so one of the young guys in the group was Ralph Rosenberg, who runs real estate at KKR right now. One of them was Richard Georgi, who ran all of real estate for Soros eventually. The guy who ran the group actually was Dan Neidig, who took the first chance on me, and he is the person who runs Dune Capital. It was the kind of, Stephen Mnuchin, who's the Treasury Secretary, was on my investment committee. It was actually a very interesting group of young people who the diaspora has been incredibly helpful when I needed things later on in life, obviously.
And another fun factor in that time period too is you were one woman of 40 men.
There were no other women in the group, that is true. Right. Which is why I got to do all the bad jobs, like setting things up from scratch and sitting on the board. So that was pretty good, actually, right? That's not so bad.
And then Steve, so taking you back to the same time period, I don't know, a fun fact about Steve is actually we are dealing with Dr. Steve Pollack. So Steve, you were a ophthalmologist, correct? Optometrist, and you had your own practice for 10 years in the 80s. We're going into the 90s here, and you chose to sell the practice and do what?
So my origin story isn't so mainstream and typical as Beth's here. I've always worked for myself. As a kid, I always worked for myself. I did all the normal things you do as a kid: mow lawn, shovel snow, deliver newspapers, lemonade stand, everything. I was always an entrepreneur from word go. Like Nema said, I went to Berkeley, got my doctorate degree in optometry, started my own practice from scratch 2 months after I graduated and built up the practice. Did that for 10 years. I took in a partner, was very successful, but I was intellectually challenged, let's just say. It wasn't very exciting for me, and I decided to exit that field. I sold my practice to my partner. While I was in optometry, while I was in practice, I was buying real estate, and that was my real estate 101 school. So I was buying rental properties. I actually bought a number of rental properties before I ever bought a home for myself. I was living in an apartment at the time. And that's how I became educated in real estate. And so when I sold my practice, my intention was to go into real estate full time, to buy real estate, hold some for rental properties, and buy some and fix and sell it, which was called rehabbing back then, not fix and flip. And so I did that for a couple of years until the downturn of the 90s happened. And I could very easily buy properties, but selling them was a challenge. So I couldn't actually make a living, although I was still acquiring properties. And so with no forethought to doing so, I kind of wandered into making my living for the next 7 years as a professional poker player. And I played poker in the card rooms in California, like a job. It was fun. I was very successful. As many of you may imagine, poker is not a game of chance, although on any individual day it is, but overall it's a game of skill. The fact that I was able to make a living, 6-digit plus income living doing that year after year says that that's the case. But unfortunately, it's a job in which you have no medical insurance, you have no vacation pay, you also oftentimes go to work with a bunch of money in your pocket and go home with no money in your pocket. So, but while I was doing that, I also started to make my way into investing in trust deeds. So that's where I became schooled at becoming a lender, by investing my own money with third-party brokers. And I don't know how far you want me to take the story.
We'll end pre-anchor here for you.
Okay, so I was investing my money in trust deeds. At that point in time, as an investor, I was earning 14% return, which was very nice. And right up until the time we formed Anchor, myself and the two other co-founders, the three partners, the three of us who formed Anchor, realized that why are we giving third-party brokers, A, the opportunity to have control over the deals, and B, the economics from most of the deal? Why don't we form a company and do it ourselves? And that was the genesis of Anchor. If you can say Genesis and Anchor in the same word.
And so, there's really a formidable time for both of you when you start thinking about the late 90s. Beth, you're in Asia, and Steve, Anchor starts. And so, Steve, let's focus on you for a second. It's 1998. You've got a partner in Anchor, and your partner is doing underwriting, he's doing sales, he's doing deal flow, and as you described it, you were doing everything else. So talk about it. Tell me about the first few years. What's that like for you? What's the experience? Kind of what's going on in your head?
So that was really my graduate school in both real estate and in lending, and understanding how to read title reports and how to understand what is the proper insurance that you need, and understanding underwriting risk, and understanding how to deal with borrowers and asset management, and et cetera. We at Anchor started with, and I don't think I told you this part of the story, but it's a fascinating story, is that most of our lenders in the first 2 years of Anchor were nonprofits. And they were nonprofits that were eligible for a program that HUD had, in which HUD would sell REO properties that they had from the foreclosure period during the early and mid-90s that they had taken back, and they would sell it to a nonprofit to try to gentrify a certain neighborhood. That the nonprofit had to resell those properties to a homeowner that had 110% above the average income of the area, blah, blah, blah. And the program was the nonprofit could buy the property for 50% of the appraised value of the property, and then could only sell the property for 10% above all costs they had into the property. So to give you, for example, if the property was worth $100,000, they'd buy it for $50,000. If they put $30,000 into the property plus $10,000 in soft costs, so now they're into the property for $90,000, $50,000, $30,000 plus $10,000, they're in for $90,000. They could only sell that property for $99,000, 10% over the $90,000 that they were in there. Even now that the property might be worth $150,000, $175,000, $200,000. So A, those properties turned every 3 to 4 months because people standing in line to buy them from the nonprofits. B, the nonprofit said, could you please charge us more money, more interest, and more points so we can make more money on our 10%? And we said gladly. And that worked out very nicely until the government shut that down.
And so, during that time too, as I understand, this is really just your own money and your partner's money at this time.
Yes.
It's really
We started with
true
$8 million
business.
of our own money, did $30 million in loans the first year. You could see what the turn was.
And so, when you follow that progression a little bit, you've got, the business is clearly building, and it's going well for you, Steve. In 04 and 05, you started expanding in other states. Kind of what's happening there? What was your thought process?
The thought process was we were becoming concerned about the concentration of our portfolio in Southern California, which was primarily where we were lending. I will not sit on this stage and tell you I was smart enough to predict the subprime crisis, because I wasn't. But we all felt as though something was happening in the real estate market that should not be happening. And in particular, the metric that we saw was a third straight in 2005, was a third straight year of 15% of appreciation year over year over year. So 15% in 03, 15% in 04, 15% in 05, that's never ever happened before. It's a phenomenal amount of appreciation. We all, looking back with 2020 hindsight, realized why that happened. But we didn't know why, but it just didn't seem right. So we expanded to other states, while at the same time tightening our underwriting guidelines. And in spite of the fact that we received much increased loan applications to be able to do more business in 2006, we actually did 15% less business in 2006 because of our concern in the market. And then when nothing happened in 2006, but yet we saw more appreciation again in 2006, in 2007 we did the same thing, although this time we did 35% less deals in 2007 because of our concern in the market. And then we all know what happened in 2008.
Right. And so, and during this same time for you, Beth, you're in Asia initially, and what are you doing? What skunk work mission do they have you going on over there?
I'm sorry, what?
What skunk work mission do they have you doing over there?
At that point, yeah. Well, we were buying distressed assets from the government in Korea and in Thailand, mostly, and just setting up the businesses to run those distressed assets because it had not been part of the vernacular. There's not really a benchmark debt market that you can do things against. And so it was really the first time ever that you'd seen NPLs really trading in those markets. And the ability to work out the NPLs was what we were building the infrastructure for. But then once that started kind of humming and everything, about the same time, probably like a little before 2006, I came back to the US. What was interesting is that I left Goldman, brought the family home, and was thinking about going back to work. And one of my friends said, "Oh, you should come and talk to the residential desk at Citi." And I thought, first of all, I've never touched a residential mortgage in my life, knew nothing about it. Was just, and she's like, "Well, I didn't say you could have the job." I said, "You could talk to them, right?" So anyway, I came back in. I did actually wind up going to the scratch and dent desk in 2006. With this theory that there might be a blip in the market, seeing some of the same things that Steve was talking about, nobody anticipating we were actually going to grow our own distressed book right there in the bank. But so I was there for about a year, and I remember that one of the things that it's actually something that Steve said is making me think about it. One of the things I kept saying to people is, we're so far from our assets, right? The whole way the residential mortgage market was structured then was so different than I was used to in the commercial market. People really didn't know what was going on in the assets, or even like the title policy, all of the granular pieces of paper that you were learning as you're like looking at the underwriting. It wasn't what was happening. A mortgage desk at that time was all about slicing the cash flows. I mean, these people were brilliant. It's not that people weren't smart. They knew how to do math that I couldn't even aspire to, right? But they're slicing cash flows and dicing them, and it wasn't about the collateral. And I kept looking at everything thinking, like, why aren't we like at the steps looking at these houses? Why aren't we site visiting? Why aren't we touching it? Because that's what was coming out of this commercial distress background that I had. And sure enough, within a year, the market started to absolutely collapse. And even though I was one of the last ones in, I was probably the only person on the desk who knew how to foreclose on something, who actually knew what happened at the servicer, or I remember explaining to people what a third-party sale was at foreclosure. They didn't know. Like, no one on the mortgage desk had heard of a foreclosure sale because you just always assumed it was going to revert to the bank. There wasn't this idea that you would have a better loss severity if somebody else took you out sooner. Despite the fact that these were quants who understood the net present value of what they were doing, but nobody was granular enough. People just weren't touching the dirt. And this notion of bringing kind of the granular piece of how does it actually all fit together, and like, what do we actually have as assets? Can we get closer to it? We consolidated down to one or two servicers, wound up having almost $4 billion of distressed assets on the bank balance sheet that I wound up in charge of managing through the rock pile of the crisis when I got there. But it was ironic because I had absolutely, again, the least experience in what I was hired to do, but probably the most experience in what actually wound up happening when things blew up, because I actually knew how to get to the assets.
And that was a lot of our conversation as well, which was, a lot of why you're able to do so well and what you're currently doing was built on the foundation of being thrown in random situations each and every time. And not only were you learning business lessons, for example, how to, while you're out in Asia, understanding what NPLs are and kind of managing going through that process, but also systemic issues, right? So one of the things that really caught my attention was you had told me...
was the distress follows me? No.
Yeah, exactly. Watch out.
I did not cause the cycle. Okay, I just happened to be there.
Does Redwood know that?
Yes.
We were talking, and one thing that caught my attention a lot was you were given the story, and I really hope you can tell the story here of the bags of cash in Bangkok.
Oh, the bags of cash in Bangkok, yeah. I mean, look, one of the other things to keep in mind is that you go into these things and you know nothing. You think you're brilliant, right? You have all the trappings of it, and you have like these great brand names, and you're waking up in the middle of the night to have, you're going to the investment committee of Goldman, and Hank Paulson's on the committee, and you're feeling important, and you're setting up these business plans. And we bought $2 billion of loans from the Thai government and set up this huge servicer. And we thought we were so smart. We went to GECC, who was the only other lender in the market, but for mopeds. Like, there wasn't such thing as like a mortgage market there at the time that was outside of the banks. And so we set up this whole servicer with them, and it took us months, and we got all these approvals. And we opened up our doors to the servicer, and the first thing that happened is people started showing up, like in tuk-tuks, with bags of baht, right? Like literally bags of cash, because they had heard we'd bought stuff at 20 cents on the dollar, and they wanted to be out at 40 cents. We never anticipated getting cash, and we created this like huge security issue for ourselves because of literally the amount of cash was overwhelming. We had to shut down the company the day we opened it, and then go back to the drawing board, and we opened it again 2 days later with armed guards and Brinks trucks and the whole ability to move cash, because we just assumed, despite the fact that we were GE and Goldman, that we assumed that the market was going to work the way the market worked in other places in the world where we had set things up, right? And that we would have ACH transfer or something. But no, nobody was wiring us money or writing us checks. They were coming in with bags of baht. And so you have to really respond immediately to what's happening in front of you. Realize you made, probably one of the bigger mistakes of your career, but just pivot and do it and fix it, right? Like, that's what it's about. It's about do what you need to do, but as soon as you see that there's an issue, don't keep taking cash when you're going to get, shot.
First lesson of the day.
Shut it down and start over again a couple days later with a Brinks truck, right? It's not impossible, but you don't know what you don't know yet, right? And so it's okay to be starting something from scratch, doing something different, as long as you just don't get so involved in your own BS that you don't know when to stop. Like, you have to pull back and say, hey, there's a problem here, and let's fix it. Not, okay, I set a business plan in motion, let's follow my business plan. Your business plan is meaningless. You got to have one, but it's meaningless once you get started.
Right. There's only so much you can plan for.
What's that? Look, and the key, though, is, recognize your mistakes quickly and act on it.
Right.
The pivot is what helps you, and I think that's why we've been successful at different hiccups. The market has evolved dramatically every step of the way since we've gotten into it, and we're just moving with the market. You have to listen to the market around you, or you can't move with it.
And this is also a time for you as well, which is another capital markets moment, which is you're spending time speaking with people at Fortress, which will come back into the story later on as well. But the relationships you make and the
relationships you make at these times also come back. That's the other piece, is that it's not important to be nice, but it's important to be clear and upstanding and consistent, and so that people know, because everyone you work with will be the person you work with next, right? I've had 4 jobs in my life. I work with all 4 companies still on a very regular, consistent basis because of the way we've interacted over that period of time.
So we now kind of toggle into really where the two of you go into massive expansion. So the Great Recession happens, and that's not in itself a time of great expansion, but this is where the foundation is built for you, Steve. So you've intentionally chosen to contract the company, right? We're looking at 2005, about 170 or so million in origination, and you've massively scaled it back, kind of seeing the writing on the wall and trying to protect yourself and the investors here. And so it's now 2008, 2009, and you kind of describe this as a period of basically not making a ton of money and just basically paying the bills, survival mode, right? But in 2010, what's happening in the fix and flip market?
It's exploding. In 2010, the fix and flip market is on fire. If we had the money, we would have done north of $1 billion in 2010. There was a lot of low-hanging fruit. It was very easy for our clients to find product, and the product that they were finding at that stage in the real estate cycle was just the simple patch and paint type of projects in which they can, for very low dollars and very quick turnaround time, reposition an asset that's ready for resale into the general marketplace very, very quickly. Our loans were turning every 6 to 7 months on average back then.
But nobody else was lending. I mean, you guys were really the only, you say it was on fire, but nobody else was really lending yet. People were terrified.
Everybody was terrified, and the institutional lenders to the homeowners were going the wrong way. They were tightening their guidelines and making it very difficult for homeowners to buy houses when that would have been the perfect time for them to make cash available for homeowners. As again, with 20/20 hindsight, we all know that that's the case. But what we were experiencing back then was most of our competitors pre-downturn were ramping up in 06 and 07, and most of them didn't make it out of the downturn, or in 10 and 11 and 12 when there was this huge opportunity which we were able to take advantage of. Most of those firms were still asset managing all the problem assets that they had that they created by overextending themselves pre-downturn.
And you talk about as well is the marketplace going back there as well to remind people is when people are going to purchase properties, they're now buying them at auction at 50, 60 cents on the dollar. And so there's this massive opportunity that's arising. So really it's a short window, but your expansion is massive in this time period, right? So going into 2011, you're talking about 143 million, you're right back at kind of where you were pre-downturn.
Right.
And what's also interesting during this time period for you as well, which is you weren't just lending during this time period. What were you doing?
Well, we were also buying. So between 2010 and 2012, Anchor bought around 1,100 properties at the foreclosure sale. And we did that for two reasons. Number one, it was a good trade for us in terms of buying and quickly fixing the property and reselling. And we did that with roughly 3/4 of the properties we purchased. And the other quarter of properties we purchased, we actually used as the ability to cement connections with borrowers, because we would turn and we would in essence flip or wholesale the property to borrowers and get a loan out of it. So we built our loan business on the back of us buying properties. And we also became much stronger lenders, understanding what our borrowers go through by being fix and flip developers ourselves.
And I'll jump to you in a second, Beth, but interesting, the parallel in both of your stories around this time period is both of you had the fortuitous timing and thought process of thinking about auction financing as well and really seeing a market opportunity arise here that very few people were seeing in that marketplace and really understanding of what kind of opportunity really rose there and how successful you could be if you did so. But going back to that time for you as well, Steve, is as understood, this is also when you started your initial expansion as well, thinking of geographic marketplaces. So started doing Nevada and Arizona as well. What was the thought process here at that time?
Well, the thought process was that as we started to have access to greater amounts of capital, which was always our issue, we were always capital constrained. But as we started to have access, we knew that in order to become a true player in the marketplace, we needed to expand our geographic footprint for diversity sakes, for risk adjustment sakes, if you will. So we expanded to our neighboring states, to Nevada and Arizona, also a little bit in the Southwest. But like Beth was talking about in terms of understanding when the market speaks, you have to act. And if you want to be successful, and sometimes you need to pivot and sometimes you need to evolve. And we were talking about at the trustee sale, we evolved into creating opportunities for our clients. We created new products such that we would collateralize existing portfolios that our clients had to allow them to go to sale with cashier's checks, oftentimes north of $1 million for them to be buying at the sale. Here in California, you need to have 100% of the cash on any property you bid at a foreclosure sale. And so we had numbers of clients that we would issue cashier's checks to every single morning, and then they go and redeposit whatever they didn't use, and the ones they buy, we would get loans from, and then we'd give them more cashier's check the next day. So we evolved with the market by creating new products that helped us grow and helped our clients also in serving their needs.
And so going into 2013, sorry.
No, I was just going to say exactly 2011 is exactly when we were seeing the same thing and kind of came out in a slightly different way. But that I had gone to auction.com because of doing some note sales, but we saw exactly what Steve was saying in the market and really spent months trying to figure out how do you finance somebody at the steps because of this you had this huge need, and because of the way the real estate market was set up, it's an all-cash deal. And so how do you finance and do the all-cash deal? We came at it from a slightly different perspective, but it's exactly that same market need that spurred us to actually start a company.
And so, taking you into 2013, Steve, is now you're originating at 336 million. So you basically doubled or so in a short period there. And so what's going on in your head and kind of
I'm
what's
glad you have the numbers because I wouldn't remember all these.
Yeah.
And so what's going on in your head at that juncture? I mean, what are you thinking about kind of the next steps and how you're going to grow the business?
Well, at that point in time, our challenge was hiring good people, training them, and while still maintaining the quality of the loans that we were doing. Mm-hmm. So, like I mentioned, there was this huge opportunity. There were other players beginning to dip their toe into the market at that point in time. I don't think at the level of what we were doing. Still a huge opportunity for us to grow. We still were somewhat capital constrained. But our main issue at that point in time was making sure that we generated loans with the same sort of underwriting parameters by hiring good people and training them well.
Right.
That was our biggest challenge in, say, 13 and 14.
Yeah, and then you're going in that time period as well, and you realizing that the marketplace that you can generate a lot more. There's capacity here, and the market's demanding more. And so at this time, you're kind of pivoting and thinking, well, I need to tap capital markets in a more significant way. We need institutional capital sources. So walk us through that process, and we've got a panel later on today on just this issue as well. But walk us through kind of what you're thinking, how you're approaching it. I know when we had talked about it, the thought process was, we originating close to 400 million at this time, but we could probably do $2 billion if we had the capital sitting behind us. So talk us through what's happening at that time.
So we made a strategic decision. When I say we, myself and my two partners, made a strategic decision to try to access the capital markets by hiring an investment banker and trading, in essence, a piece of the equity of our company for greater access to the capital markets. And so we hired a banker. We ended up through a 9 to 10 month process of connecting with a New York-based PE firm. And we sold a minority share of Anchor with the thought process that 60% of a much, much larger Anchor is way more valuable than 100% of a smaller Anchor. And that's exactly what happened. And we basically exploded to over $1 billion very, very shortly after our strategic relationship that we currently have with Wafra Capital Partners.
And so from that point forward, now we're going into kind of 2016 is continued expansion. And this is also, you're doing a geographic expansion each year as well, right? So each year you're expanding kind of 5 to 10 states. Kind of same thing is basically, we've got the capital now we can scale it. And the only way to scale it is to keep going out in the country.
Correct, yes.
And so, Beth, you had touched upon this a little bit as well, is kind of, the pivot is interesting. So you're at Citi, and you have fortuitous timing there because effectively you're the only person who knows how to run not a distressed debt business in a place where they were not expecting
to be in the distressed business as deep as they were, but right. They got there. Look, it was interesting. I actually started using auction.com to sell some real estate off of the bank's balance sheet because as the broker-dealer, you're not allowed to hold real estate more than a certain period of time. You really have to move it fast. And I'd given a reference check as a client to Stone Point Capital when they made the investment in auction. And so a couple years later, when they decided to build out a loan platform, I was on their list from this reference that I had given kind of several years before. And because I was also a client of theirs, I was on, each of the groups came up with a list. I was the person who was on both lists. And so went over there to start a loan program. And it was a lot of the same dynamics that Steve was talking about that are going on. So this is 2011, when the foreclosure auctions were really starting to pick up steam. But there was this notion, how do you finance somebody at that auction? And if we could bring financing to it, would that be something that would actually, it's not that they were in the benevolent society, they actually wanted to drive more assets through the auction process, right? And so if we could fix this thing that was holding back the real estate market, we might be able to do that. And so we came up with a structure that would work so that people could bid, with cash at the auction, but where we felt as lenders that an unwind, a rescission, some other type of event would push the capital back through us and not back to the other person. And I think Steve probably solved the problem by having a long time stable of clients that they knew and that they had other assets with and other things, and we solved the problem with some some legal mechanical stuff so that we could actually try to do it with people that we didn't know, right? There's different ways to come at the same problem with a different solution. And so we were actively, that was the first time actually I was working on loans that actually were supposed to pay back. So I was pretty happy about that. It'd taken me kind of, more than 15 years of my career to get to a performing loan. But you can make money either way, really. But now I try to actually get people to pay back. It's a much better strategy if you can do that long term. But it was interesting because Stone Point Capital, which was the money behind auction, only really wanted to do about half of it. And it was at that point I went out to Fortress, I went out to Colony, and a couple other people that I knew from earlier to see if they wanted to be the other 50% of the capital. And it was interesting because it was 2011. People were frightened of this strategy. They were not ready to do fix and flip yet. And in fact, we were aggressively against people doing it for rental because we thought those assets were going to get stuck. We only wanted flippers. Our first strategy was if somebody's planning to rent, you stay away from them because there's no takeout. You're going to get stuck in the loan, right? We were really looking for velocity. We were looking for the lipstick flippers, who were just kind of putting some paint on and stuff. And so we were using the data to try to identify those people. Again, I was staying away from rental. Colony turned me down flat. They were like, wow, this is really scary. We would never do something like that. But they come back to me 3 years later, right? Fortress was actually way in, but we wound up doing it with Starwood just because they were also invested in something else with Stone Point. And so we did have some institutional capital that was interested, but for the most part, people were terrified in 2011, right? I mean, you guys knew what you were doing and had come back, but most people were really still burned. Right. And so, fast forward 3 years, and I get this phone call from Colony, the same person I had called 3 years earlier, who was afraid of the fix and flip business. And they said, hey, we're doing this rental business now, and we'd love to refi your loans. Let's meet for a drink. We meet for a drink, and then a couple days later, he's like, forget this. Come here, do this for us. Grow the rental business. Let's bring in fix and flip. Let's do the whole thing. And I was like, no way. So I give them a couple other names. I don't want to move to California. They come back. I've been in California now 2 weeks, a month since then, but I did not move. So who was smart there? I don't know. But, I still live in New York, but I am here all the time. Starting with, Colony did convince me to go over there and start their private lender at about this time. And again, off of, I think, some of the earlier conversations that we had in 2011. And that was 2014 by then, so.
And tying into that too, because that was part of the story I didn't even understand too, was so you're now at Colony, right?
Right.
And now you're at CoreVest, right? But they are one and the same. And so
they're the same company, yeah. We just changed the name because we changed the capital source. When Colony American Homes, so we were together with Colony American Homes, who was the equity strategy. So similar to what Steve was saying, a lot of capital decided it was great to be in both the debt and the equity. And I think from Colony's perspective, they were in the equity sooner. And they thought, wow, if I can be at 100 cents on the dollar, wouldn't it be nice to be in at 75 cents on the dollar, same yield? It was interesting. You don't get the HPA, but if you're just looking at kind of yield on the balance sheet, it's pretty similar yield, actually. And so when Colony sold Colony American Homes and they did the IPO, the bucket of capital that was in there, that is the issue with institutional capital. It's fantastic, but it does monetize at some point. And so when that monetized, we were only 10% of the capital in that fund. It was time to restructure the capital base, which is when Fortress came in. And next time you start a company, Beth, note to self, you don't use the name of your capital source because then you have to change the name overnight with your brand on the day that you change the capital source, which you guys didn't have that problem because you brought the capital source in later, but I was employee number 1 at Colony, so. But it is the same company, we didn't change anybody. And even now with the most recent transaction we now have permanent capital with Redwood Trust, it's still the same company, same people.
And so, both of your arcs are really different, and both of you kind of massively scaled. Was there a breakthrough that you thought, kind of was the tipping point for your business?
The tipping point for our business really was our transaction that we conducted with WAFRA and bringing them in fold and allowing them to supply us with the mezz capital we need in order for us to go into the marketplace and get really low-cost senior debt in place. So we hold the vast majority of the loans that we originate, we hold on balance sheet, which is supported by senior debt. further supported by WAFRA MESDET. That was a tipping point. That allowed us just to grow as fast as we wanted to grow at that point in time.
What about you, Beth?
It's a good question. I mean, look, the permanent capital base is really critical, and how you can achieve that in different ways. We securitize our portfolio loans, balance sheet, but we never sell out of the risk. So we actually we securitize to match fund. We've never not been in a loan that paid off, right? So we hold at least the bottom 10 to 20% of any securitization that we have, so we're always first loss risk. And I think that makes a huge difference if you can get the type of capital that it's such an efficient capital source. As the market starts to move, you can move with it, hopefully, and have the type of products. But it's both the capital funding piece, but then I think one of the reasons we've been successful, and I'm sure it's one of the reasons that Anchor's been successful, is that you actually listen to what your clients are doing, right? And you do change it and you do tweak it. And if, we've been doing build to rent since we started, but we weren't really calling it that. We had some clients who just did that. Maybe we were refining this piece or that piece, but building something so that, again, there's real frictional problems with mortgages and real estate, right? That if you have a construction loan and then it has to be a permanent loan and then and there's all of these fees and drag every step of the way. If you can step in and figure out like, wow, how do I take somebody without messing with my lien, without getting the wrong valuation in there, without getting all these things, can I really get somebody from the ground all the way to a 10-year loan on their rental community? If you can do that, you're solving their problem. It's not about the next 10 or 15 basis points. It's, because the friction of doing stuff in real estate is so high that understanding the market really well, understanding your products really well, and just plain listening to your clients, you're not going to be that constrained, again, by the next 20 or 30 basis points.
100% agree.
And
that's part of the reason our industry is so fragmented, because it's not easy to figure all that out.
It really isn't. And it's really, as everyone in this room knows, it is really different market by market. And so if you can't, how do you take something that's different market by market and turn it into, we like to say at work, burger, fries, and shakes, right? We are a commercial lender, but we need to be able to move with the efficiency of a residential lender. And so how do you take something that's really complicated and make it burger, fries, and shakes? And that's where I think the art comes in, not just the science, right?
Mm-hmm.
And I think both of you have really focused on that side of it in terms of how to scale the efficiency of your business, in both in the technological perspective, but it's really from a process orienting your people and the process around it to make sure that you've taken out as much of the friction from the process as possible. Like what are the things that you're actively doing on that front?
Well, I mean, the technology is key, right? And this is not it's not a weapon system, right? It's not brain surgery, the technology, but we've crawled through a lot of broken glass, and you can set up a system. Like, you need to set up a system that these really hard loans can close in a short period of time. But as Steve said earlier, you can't just close them, right? You have to actually, the underwriting has to be right, the people have to be right, your thought process. This is not an easy train. And so we've been able to build things that hopefully are tools that help all of our employees get there faster.
How many tech people do you have, Beth?
Oh, I don't have that many. It's not a huge number.
I know. How many do you have?
Right, 4.
Steve, how many tech people do you have?
We have 15 in-house and 25 offshore.
We also outsource them.
Sure. But you've both effectively built your own internal proprietary systems to kind of manage this process.
Yes, there is no shelf you can go to in private lending and take the thing you need off the shelf. That means humans, and it means technology.
So what's the greatest challenge you're both facing right now?
I'll go first.
Yeah,
the greatest challenge I'm facing for our company is hiring good people. It's a very, very tough market. We're very, very slow to hire. We currently have 23 open positions that we've been trying to fill. It's important. Our success, Anchor's success, is built around our culture and around our delivery of an excellent customer experience. We're not the cheapest. We're never going to be the cheapest. But we do things for the customer that keeps them coming back, and we were able to scale at a fairly large and both dollar-wise and geographical footprint-wise, while keeping the individual sort of one-on-one relationship.
Yeah,
That's what needs to happen in this business, because otherwise you just turn yourself into a bank. And if you turn yourself into a bank, I mean, your clients are going to go to a bank.
Well, and we don't have bank capital either. We can't be the low-cost provider. We think we're competitive on price, but we will never be the low-cost provider. That's just not, we're trying to be the solution provider, right? At a competitive rate, but the solution provider. And 100% we're constrained by the people we can hire right now, not by the opportunity we're seeing.
Right. Right.
And when I say hire, it's not that we don't just hire people and drop them in the seat. Like we have to invest months and months and months in people before they're really doing whatever it is that we think we do. Because again, there's no shelf that you can go to and say, I need this type of underwriter.
Yeah. And also too is, I mean, you're also facing challenges there, Beth, as well, which is, Redwood, the new capital partner, and now we've got Five Arch coming in the mix as well.
We do have an integration project.
Right, a small one, right? So what's that like? And what kind of challenges?
It's like another job. It's just
right.
You just add it between 2 a.m. and 4 a.m, right? No, it's fantastic actually. I mean, one of the best parts about it is that it is hopefully a great pool of talent that's already trained. It's really rare to walk into another pool of talent that is already trained in your market and be able to access that talent. And so to me, that's the most exciting part about the integration, is that we are able to combine two very strong pools of talent, because that is really one of the hardest pieces. We grow so slowly because of the adding of the people one at a time.
And kind of why do you think, because we work with hundreds of different organizations, and I think the vast majority of them would like to scale in a significant way. Very few people do we know really want to stay with marginal increases, but very few can actually do it. Why have you been able to do it?
I just think it's a lot of the themes that we've both been talking about, in that first of all, I think we both care deeply about building a process that does work, right? And that you can replicate, right? I'm sure that, without even knowing Steve well enough, I'm sure that you have backed away from business hundreds of times. Like, I absolutely leave the loan on the floor. We are not chasing every loan. Back away, figure out how to do it, and then do the loans, right? Don't just jump at everyone. Look, we're entrepreneurs at heart. We want everyone, and we're competitive people. We want every loan, but I think if you have to have the discipline to say, I can't do that type of loan well right now, I'm going to build the process first. I mean, the first thing I did at Colony was, they had done like 1 or 2 loans when I got there, was shut the whole thing down because I thought the docs didn't work. They were literally negotiating every single doc like it was a CMBS loan. And by the way, it is a CMBS loan, right? And that is how we securitize it. And it trades off the CMBS desk. And I understood that was their background. But the first loan they did for $3.2 million had a legal fee of like $60,000, $70,000 on it, which is really normal for a CMBS loan, but their average value is $50 million, right? And so I said, look, we can't have all these negotiable documents. So we came up with a modular approach. It's still a CMBS loan. It has all the bells and whistles, but we'll close it for you for $5,000 if you don't negotiate. You want to negotiate? I need a $20,000 deposit, because I already went out and bought all of the stuff that goes with it, like the state legal opinions and there's a ton of stuff that goes into a complicated CMBS transaction that I bought across the board so that somebody could do it, like I said, burger, fries, and shakes. And so if you're not willing to take a step back, leave business on the ground that you shouldn't be doing right now, you won't ever scale. You got to build the infrastructure that's there so that you can scale.
So I agree with everything that Beth said. I'll come at it from a slightly different angle, and that is, I have a firm belief that most people who say they want to scale truly don't. I think most people look at, why can't I scale? What could go wrong? It could be this, and maybe I'll have this problem, or maybe I'll have that problem. And they see all the negatives, just like the very, very first speaker was speaking about, in terms of your mindset attracts your lifestyle. And so there's too many people that see what the problems would be in order to scale, as opposed to seeing what the opportunities are. We're seeing those problems as opportunities for solutions, so applying creative solutions or your entrepreneurial spirit or whatnot to being able to scale. I think every single person in this room could take their business and 2x their business in 2 years if they attacked it and had the right mindset. That's what I believe, but I believe most people don't want to do it because they self-sabotage.
And one thing that I remember in our conversations, Beth, as well, was I would just dub you a data junkie. Tell me some of the data points that you currently track.
Oh, you don't want to know, but the poor people who work with me, I am a huge consumer of data, and we measure everything. And from the beginning, I've always known I was this way, and so we have actually set up our systems to milestone almost everything. But it's great because I know exactly how many days it takes to go from, blue to green or red to yellow or whatever. And I consume that data. Like people know that if I get a report, they're going to get a question. Like I'm not just like looking at the overall. I really dig into it. So I'm quite granular. We literally measure everything, and have from the beginning. So it's great. Like I now have the 6 years of data on certain items that just didn't exist in this market.
And so, we, as an organization, Ross LLP really has a teaching culture that's very important to us. And so we're constantly reading books within our own teams, within our, as the entire firm reads books together. And so we kind of have a culture in which books are extremely important and pushed down. And I know the influence they've had within us. What's probably the best business book you've ever read and why?
So one of the most recent ones that I think goes to exactly your last point, I don't know if anyone has seen the Reid Hoffman book, Blitzscaling. I'm a huge fan of it. And I actually came across it before it was a book, when it was a PowerPoint presentation of a class that he taught at Stanford that turned into the book. And I just remember suffering at each point in growing the business that I was somehow doing things that were wrong. And then all of a sudden I find this construct and this idea that you're supposed to break at each of these points, and that it's normal. I mean, not a massive control break. Let's not send out capital that we don't get back, but you're allowed at like 50 employees to have certain things happen, because you're going from your family and everybody knows what's going on, to your tribe, and there's tribal knowledge, and you're wearing a ton of hats. And like Steve, the first year and a half, I was the marketing officer, I was the technology desk, I was almost everything, right? But then you become a town and you have to have a little bit more, and then all of a sudden you're like a city. Cities have laws. And it's really, really hard to go from the person who had tribal knowledge to the person who has rules and laws. And these are normal breakpoints in an organization, and it freed me up, this notion that I was allowed to have these things happen that were not necessarily good, or that it was okay for the managers who I thought were amazing to all of a sudden be struggling because they had to stay in their swim lane instead of doing the 3 or 4 things, because I'd surrounded myself with the multi-hat wearers just like I was, right? And so these are normal. What I liked about that book is that it sets you up for this normal evolutionary process of a startup. It looks like you've read the book too, right? It's good, right? Mm-hmm.
What about yourself, Steve?
So my favorite business book of all time, you said business, right?
Business.
So my favorite business book of all time is Simon Sinek's Start With Why. It was the first book I reviewed in my 2020 year of books on LinkedIn. Anybody who follows my LinkedIn feed. It's a phenomenal exercise and explanation of how you build culture, how you build something that matters, and why it's necessary for any business owner to make sure that their team members, we don't call them employees, we call them team members, feel respected, feel valued, feel as though they matter, feel as though they make a difference. Otherwise, you just do and have employees and somebody offers them $1 more and they're gonna go somewhere else. You want them to be there together with you, with your cause and your mission, and feel as though that if someone offered them $1 or $2 more, that wouldn't be worth it. So it's a phenomenal book. It gives a whole bunch of examples why the Wright brothers succeeded, while other ventures much better capitalized and much better supported failed, and so forth. So I highly recommend it. It's a read in an afternoon.
And one last question for both of you before we open up the floor for a brief few minutes of questions here for anyone who's got questions for them. What's one kind of parting piece of advice you'd want to give to the people in the room here who want to compete with you in your own space?
I welcome it, I really do, because I think one of the reasons that Redwood actually just did this transaction, and one of the reasons I'm excited, is we're still really at the beginning of what to me is a different asset class. It's neither commercial nor residential. It's not a blend of the two. And we in this room have the opportunity to shape that asset class. My aspirations are not to do the next $2 billion, $3 billion, $4 billion. I want to be one of the people who, when they look back and they say, wow, this is a whole asset class, that we made decisions that impacted what those loans look like and how those loans pay and what is the finance. This is a structural component of the US housing stock. This is something that actually helps feed value. There are so many positives associated with the asset class that we're funding and that we're bringing along, that I just think we're at the very beginning, and that we're going to see the whole class grow. And so therefore, I hope there's a lot of other really strong players along the way.
Piece of advice from me would be, I believe that there's enough room for everybody. I'm not of a nature in that if I do better, you do worse, or vice versa. Rising tide lifts all boats is a common adage that many people go by. And therefore, I believe that it's in our best interest for all of us who are in this asset class to look after each other and to do things the right way.
Yeah.
And therefore, I've always been very, very open. I've always been very accessible. People who don't know me very well, but want to pick up the phone and call me and ask me a question on how to do things better, I'm open for that. I'm open for advice. I'm open for giving you my opinions, whether you take them or not, whether they're right or wrong. They're just my opinions. But I'm here to help you. If you want that, I'd be happy to do so. I think it serves all of us, all of our best interests, if we all do things better. I don't think anybody wins if a company underwrites poorly and is left in the dust, so to speak, in the next downturn. I don't think that serves anybody's advantage. So feel free to do so. That would be my advice for you.
Thank you. And we'll open up the floor we got a couple of minutes here left for questions, if anyone has any questions.
No questions, we're done. Okay.
Yes.
When sooner or later regulators are going to show up and take interest in this industry, what do you follow? What do you worry about? Or is it just me?
I actually don't think this is going to be that highly regulated because there already is some regulation around it. This is not a consumer loan. And I don't think it's inevitable that the consumer regulations show up because there is not a consumer here. And the incentives, particularly in the rental loans, are to keep those renters in place and paying and keep those neighborhoods strong. And all of the incentives are actually already built in to be the type of incentives that the government would want, for neighborhood growth and valuation and things like that. So I'm not seeing a big looming threat of regulation.
Nor am I.
Great. Anyone else? One last question. Yeah, one last question. Go ahead, Frank. Go ahead, Frank.
Frank from Untitled Chapter in New York. What's interesting is, culture is important in the firm, and people making places, not places making people, right? So
100%. Yeah.
So when I was in Blackstone, I had to hire people most diverse, but I learned that the corporate America was against it. Because they were afraid, because of diversity. My question to you is this, and now we as a firm, we try to look for best talent, and what's interesting is we look for emotional intelligence. Because emotional intelligence is that 10% piece that you can teach everybody to put one thing to another. You can add up 2 plus 2, but emotional intelligence is so hard to find. So what would be your best advice or your maybe experience you can share what exactly are you looking for when you're looking for that talent? Because the talent is so hard to find.
So you're echoing the challenge that I expressed earlier in the talk about hiring the right people. Emotional intelligence, or EQ, is an important part of that. We use that as part of our hiring process. I'm sure, Beth has at her firm has a whole process that she goes through as well. Part of what we do is we have a set of parameters around every single job in our firm. That some parameters require a very social person, some parameters require a very detail-oriented person, et cetera, et cetera. And there are a number of different model types that each job description or each job may fit. And we try to hire people that have that psychological profile or that predictive index, if you will, to fit the job. We care less about experience and about knowledge. That's a commodity. In today's world, that's a commodity. You can teach people that. You can't teach people to be nice. You can't teach them to be empathetic. You can't teach them to listen to people, right? You can to some degree, but that's not who they are as a core nature. It's a problem if that's what their job requires. So that's how we go about it.
Yeah, I would say my number one attribute that I'm really looking for is curiosity. Is this person going to really dig in? Because I actually you can't really hire for experience in this bespoke market. And every once in a while you catch somebody, but that's not what anybody's really looking for. We're looking for people who have the curiosity and the drive, who want to understand it and want to be part of a market that's new and changing.
Thank you both very much. This has been really, it's great to have you both on stage, so thank you for your time today.